Chris Preston.
And I'm Brett Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has been delivering investment advice for 55 years to individual investors. Brad, we're in a little better place than we were a week ago. We'll get into all of that. But more importantly, I want to talk about the experience I had at my son's birthday. Uh, my son turned 11 this week, and I took him and three of his friends to an escape room. It's the first time I've ever done one of those. I know you're an escape room veteran. It was Area 51. It was like the alien themed one. It was a lot of fun.
Nice.
We didn't quite make it out. We
Oh,
didn't quite make it out in time. The guy said it was the hardest room, and only 20 to 25% of people actually solve it. And he was impressed as how close we came. Maybe he says this to everyone, but it was fun. The hour flew by. I don't know. Are you ashamed of the fact that we didn't get out?
honestly, yeah, a little bit. I, I think the 20 to 25% number they just tell you to make you feel better. Because like
Maybe.
that's not a sustainable rate of success for a room. They would have to mix it up. It's too many people failing. The important thing though, did the kids have fun?
Oh, they had a blast. Yeah, they loved it. And I would offer uh, my thoughts occasionally, but I tried not to, lead the charge, so to speak. I let them.
Oh, well, then I rescind my criticism. If you were just like a passive observer and it was a bunch of kids doing it, I'm not going to criticize their inability to complete the room.
I was semi-passive. I think I
Okay.
would, I'd dip a toe and then, get out and let them figure it out from there, kind of a thing. So.
Was that your guys' first escape room?
All of us. That's why the guy said he was impressed. Now, again, he may say that to everyone, but bunch of 10 and 11-year-olds, not bad. He showed
The
us the last two steps. It was like two steps. We were two steps away, and he showed us at the very end what they were. I don't know. Did they switch those things up so that if you go multiple times, you don't know exactly what's going to happen? I don't know how that works.
No, you got to do a different room. So like you can't. So they actually there are companies that like franchise out essentially. They sell packages that of the puzzles. So you probably should avoid the Area 51 rooms when you encounter them because it'll
Yeah,
probably be a lot of the same stuff.
yeah.
But you can do new rooms. Did you have other options at the
And
spot
there's
you were
like
at?
two or three others, I think, and then there's other escape rooms around that have them, but
Are your
yeah, I'd
kids
always been
already
escape indifferent to the idea of an escape room, but it was fun and it was a good. My son had a good birthday as a result.
has he asked to go back yet?
Not yet, but he said he could see going back
All right.
for birthday or otherwise. So yeah,
Good.
um,
Those are a blast. Love those. Go to an escape room. That's your mission this week.
yeah. I'm sure our audience is a big escape room audience. Who knows?
Champing at the bit.
Yeah. Okay. Let's escape rooms and get to the market. Tell people what we're going to talk about today.
Well, I mean, obviously, we are going to talk about the fifth biggest rally in the history of the S&P. In response to the tariffs coming down at least temporarily.
Hmm.
Um, Talk about some of the hard numbers versus the soft numbers. Inflation is lower, but consumer sentiment measures had a release earlier today that was the worst on record, I believe.
Yeah.
And then we're going to talk about maybe what we can learn from earnings season. Is that going to be the thing that really gives us direction for the market going forward?
And before all that, as usual, we are going to do defend the take. And Brad, you're up this week, and your take, for which you have 90 seconds to defend, is that earnings season will be the first real opportunity to buy the dip. You have 90 seconds. Go.
Okay. The market has been absolutely falling apart. The bond market, near as I can tell, is the reason that Trump paused tariffs. There was some serious deterioration in the Treasury bond market owing to some heavily leveraged trades. The basis trade you will probably see headlines about, but Trump responded to it, so he blinked. Not passing judgment on it. I think it's the right move, regardless of what the motivation for doing it is. But we are still very much in a spot where consumers expect the economy to weaken a ton. I just said it a few minutes ago, but lowest consumer sentiment measures in years, decades even, but it's not bearing out in the hard numbers yet, and those lag. We talked about it last week. There is a long tail on the impacts of some of this stuff. Earnings season is going to give you the first assessment by a company of what it expects its marketplace to look like, its business conditions to look like. Also, we hit bear market territory on the S&P intraday. We've come down 20%. I think there's going to be value opportunities for some of these companies that oversell beyond that get oversold beyond where they've already come down. This haircut that we've experienced so far is based on lower expectations. It's not based on hard results yet. But if we see companies that are selling off that are down 30%, 40% from their highs in mid-February, in reaction to maybe an earnings miss, I think you're going to find some value opportunities. And I think that company results are going to give you the confidence to get back in the water and get off the sideline.
All right, almost hit the post. Yeah, I mean that all makes sense. Yeah, earnings season could be a welcome distraction, if nothing else. Who knows if it the degree to which it attracts investor attention could determine how much of a rebound we get out of it. If that makes sense.
Yeah.
If tariffs still just absolutely dominate and suck up all the energy, now theoretically we're in this 90-day pause, so hopefully that won't be the case, but you never know. If we turn our attention to earnings, and again, we're going to mention hard data versus soft data, we could see that dichotomy in within the earnings reports themselves, where like the earnings from this past quarter were good, yet the guidance is we don't know or underwhelming. So that could play out. But yeah, I do think that this is the first real catalyst for a rebound. Is the start of earnings season. We're starting today with a few banks. Um, yeah, sorry.
Yeah.
Finish up.
Well, I think that there is, I mean, look, China came out this morning and said we're raising tariffs on U.S. goods imports, but we're not going to raise it again. So they're standing their ground or drawing a line in the sand or whatever. Uh, President Trump does have an opportunity to do the same thing. He can say, all right, well, then this is our final tariff.
Mhm.
Meanwhile, we're still open to negotiation. Um, I think the biggest fear on the street was that he wouldn't budge on what were really draconian tariff rates.
Yep.
I mean, Vietnam nearly 50%, right? Like if that's it and he's not moving and it's not really a negotiating tool, that's the worst case scenario. If it looks a little bit more like a negotiating tool or like there's room for progress, like a 10% across the board tariff is I think what the street was pretty much expecting before
Right.
the announcement or something in that neighborhood. So this gets us back to a baseline of like relatively stable expectations. And it's more in line with what I think everybody was anticipating coming into the year. Um, the fear, I guess, would be that companies say, well, the uncertainty is still too high. We're just going to pull guidance. Honestly, if they come out and if individual companies come out and they're guiding a little bit lower than expectations, but they're still offering guidance, that's a great sign.
Right.
That means that they are able to price in some reasonable expectations. If they're pulling guidance entirely, that means that business leaders are still seeing the environment as being too uncertain to make any kind of reasonable judgments. That I think spooks the market. But you really had a good point when you were talking about whether there's even room for these numbers and these reports to breathe, given how bombarded we are being with headlines right now.
Yeah.
Um,
If there is, that's a good thing, I think.
yeah, today has felt like very much the market taking a breather. Like
Yeah.
we've been up
Feels
and down.
feels better than last Friday when we were sitting here.
Yeah,
This was our wish that we'd have a calm day. And as of this recording, who knows when it actually gets out to
yeah,
people's eyes and ears. Yeah, market is like not flat, but close to, up less than 1%. Anything that's less than 1% in either direction feels like a breath of fresh air.
yeah. Yeah, less than a 5% swing on any given day,
Yeah.
and volatility coming down. Um, Mike Santolo has written a lot about some of the weaker indicators, or not weaker indicators, some of the some of the measures he looks at showing weakness, like new lows, stuff like that.
Yep.
And the one thing that we've consistently been hearing and reading from him is these typically come around near a low, but maybe not the low.
Yeah.
Um, and that is, I think, consistent with how the market is moving right now. Is it at the very least, it's a breather. Could we
Yeah.
plumb lower? Yeah, maybe. Could we bounce back? It's certainly possible. As always, I skew bearish. I think there's probably still room to go, but once we start getting some numbers in from these companies, we'll be able to make reasonable assumptions about what their growth paths look like for the rest of the year. So, watch earnings season, and hopefully the headlines slow down, calm down a little bit.
Yeah, and before we get into our big three and what happened on Wednesday, we forgot to mention that we do have a guest today, Bryan Perry, who's at least I don't think we mentioned, author and founder of Cash Machine, which is a high yield investment newsletter, also senior editor at Eagle Publishing. He will be joining us in just a little bit after our big three. So looking forward to having him on. Okay, Wednesday, like you said, the fifth best day in the history of the market. S&P up more than 9%. Um, Nasdaq up more than 12%. I think the last time we saw numbers like that, I think you said was the Great Depression, which was not a great comp, but
So the best 10 single day gains in the S&P history before April 9th were March 15th of 1933, 16.5%. October 6th of 1931, 12.5%. October of 2008, couple of days in there, 10.8 and 11.6% respectively. Then April 9th of this year, and then the right coming in right under that is March 13th of 2020, the COVID crash. So these big swings come in the midst of panic selling.
yeah,
Right, it's the dead cat bounce. It
yeah,
is the relief rally. It's all of that. In most of those cases, those big day rallies were not coming off the bottom. Um, in every instance, there was still lower to go, but it's also tough to read too much out of a sample size of what is essentially the four biggest financial crises in a century,
yeah,
like or in the course of a century, right? Like they are all so individually different that you can't really take a ton away from it. But as far as the rhyming aspect of it, big bounces come in the midst of big declines. Dead cat will
yeah.
bounce if you throw it hard enough.
And I mean, the hope is the dates you cited there. You know, the one that gives you maybe the most hope is you said March 13th, 2020. Well, that was the bottom, like that was when things finally turned around. So that rally actually did start a V-shaped rally that lasted basically until late 2021. So if you're looking for a sign of hope, that would be it. But the others, October 2008, the bottom didn't come until I think March of 2009. So who knows? The fact that markets are calm today is a really nice sign. Um, we're in this 90-day pause, theoretically, and so maybe things will be a little calmer at least during that period. But who knows? Trying to predict things in this tariff, focused tariff-centric market is definitely a fool's errand. But
Yeah,
as we sit here now, feels a little um, more palatable than it did a week ago.
yeah, it's important to remember that we are one tweet away
Yes.
from the market skyrocketing or drilling to the core of the earth. I like that. That is the sort of uncertainty that we're faced with right now. So it's a little bit, we said it last week. Don't be a hero. This is not the environment where you want to be
Yeah.
investing your. If you've been sitting on the sidelines, I'm piling everything in
Right.
right now.
VIX
You
is
want to
still at
do it.
43. It's up
Yeah,
today. So that's very high.
yeah. VIX is super elevated. Bond yields are climbing still. The 10-year was last I checked just below 4.5%. It has swung up very, very rapidly because of concerns about a flight to safety away from U.S. assets in general, or maybe not a flight to safety, well, partially flight to safety and partially in response to us sort of showing our true colors as an unreliable business partner. Um, so there's still a lot of things to be worried about macroeconomically,
Yeah.
but in the moment, we have at least stopped to catch our breath.
Yeah. Much needed. Yeah, this is it's nice to be sitting here doing this and like, every time I glance at the S&P, it hasn't swung 3% in a different direction.
Yeah.
Uh, it's sort of sitting there for now. Okay, let's move to number two. You talked about sort of the difference between hard data and soft data. And that was on display just in the last few days. Inflation came in, or sorry, this is core inflation, right? Was lower than it's been in 4 years. Good thing. So there's hard data improving, continuing to improve. Then today, consumer sentiment, there's just sentiment came in, I think it's the lowest reading ever. Is that right?
So the University of Michigan Consumer Sentiment Survey came in with a reading of 50.8. It's the second lowest reading on records going back to 1952. And it's some of the second worst on record. So it is bad, bad. It was down 11% from the last survey.
Yeah,
So people's expectations have certainly gotten worse. And there's probably a feedback loop with, well, I know the tariffs are coming. I know that's going to hit my finances.
right.
Also, my 401k just dropped 20% in a week and a half, right? So it's self-reinforcing in that regard. So it's probably a little bit of an overreaction. I would think that if the market stabilizes or flatlines and is just moving sideways, it probably improves next month.
Yeah.
Um, but yeah, yeah, that's the big push pull right now is do the hard numbers hold up and the economy weathers this storm better than people are expecting or better than people are afraid? Or are consumers right to be scared? And do they start pulling back and then contribute to economic weakness? And I think that is even if the tariff thing gets settled, I think that'll become sort of the next narrative on the street or the next thing to be worried about.
And we've talked often about how investor sentiment is low investor sentiment is generally a bullish signal, contrarian bullish signal. When investor sentiment bottoms out, which it is, that generally is a sign we're close to, a buying opportunity. We don't talk about that with consumer sentiment necessarily. I don't know what the correlation is there. It might be somewhat correlated, investor and consumer sentiment, but maybe not quite to this degree. Um, I don't know what you can take away. I think you're right that the behavior of the market may dictate that consumer sentiment over in the next month. If we're sitting here a month from now and things have at least calmed or were up a fair amount, like if your earnings season being a buying opportunity, um, comes to fruition, that could really, improve things in terms of consumer sentiment.
So just hold this up pretty quickly. If you chart consumer sentiment from the University of Michigan survey against the S&P 500, um, it's sort of a mixed result. The
Yeah.
the consumer sentiment numbers on what's this in June of 2022, so in the middle of the last bear market, came in at like 58.4, so still higher than we are right now. And that was sort of partially on the way to a bottom, but it preceded the bottom. It did hit a low of 50, which is the lowest on record, at the end of June of 2022.
Yeah.
And then we didn't end up bottoming until the end of what, August, or I guess no, end of October, September, somewhere around there was where the bottom was. So at that time, consumer sentiment had sort of bounced back a little bit. Um, '08 would be I guess, maybe one of the better comps for it, where consumer sentiment crashed and then rebounded a little bit in like July of '08 before it then bounced along that sort of the bottom of its range
Yeah.
until 2009. So
Yeah.
there is certainly precedent for consumer sentiment hitting a low and then the market continuing to trade lower. There have also been instances where consumer sentiment also marked the bottom.
Hmm.
We saw that in '01, when the tech sector blew up with the dot-com blow up, consumer
Yep.
sentiment, the bottom there coincided with the bottom of the market.
Is that post 9/11, I would assume also, or no?
Yeah, so that was
Yeah.
post, that would have been like '03 is when consumer sentiment got as bad as it got in that post-dot-com crash era.
Yeah.
Um, the the thing that is a dividing line for me is the Fed.
Hmm.
If the Fed starts quantitative easing, starts buying up bonds, opens the floodgates and turns the money printers back on and starts like rescuing everything, that's obviously good for stocks. It's inflationary. Uh, I mean, we will continue to be the show that talks about the Fed, even when we shouldn't, for the foreseeable future, I think.
Yeah.
Uh, but I think we should get some indications of whether they're willing to continue rolling the dice on inflation. They've been sort of setting the stage for a hawkish tone in the upcoming meetings, because you can fix consumer sentiment pretty quickly. You can't fix inflation quickly,
Right.
especially if you've been fighting it for almost 5 years at this point.
Yeah. And the odds of rate cut, we gotta, since, as you said, since we always talk about the Fed, odds are now up to 25% for next month, May, um, which was near zero last time we were sitting here. 75% still think they're going to hold rates flat in May. And then now in June, we're up to more than 80%, like 82% think that they'll cut rates by at least 25 basis points, if not 50.
Wasn't that 100% a week ago?
I think it was. I think it was
Like 99%.
99 point something. Yeah.
Yeah.
So
But
yeah, we'll see.
I mean, this sort of circles back to hard versus soft numbers. The Fed is responding to hard numbers.
Yep.
The market betting on them cutting rates is sort of a bet on they will start moving in anticipation of declining hard numbers based on sentiment measures and the expectations for what tariffs could do.
Yep.
So we'll see when it comes to it. I don't I'm hoping the economy is strong enough where we don't have to have like emergency cuts, which is essentially
Right.
what these are.
Right.
But who knows if Powell will still be running the Fed? The recent Supreme Court decision allowing Trump to terminate some independent agency heads while it's subject to Supreme Court review just came down the wire a couple of days ago, yesterday. I mentioned to you there is a possibility, because Trump has asked for Supreme Court review by April 15, that 2 episodes from now, the Supreme Court may have given him authority to remove Powell. So how hawkish he is may be irrelevant at that point. Although I don't know what would happen with the Board of Governors and the rest of the Open Market Committee. There's still
Yeah.
a lot of uncertainty out there.
Like the Fed, I think we have to go with just the hard data so far, and
Yeah.
that we can, it'll break our brains to go with the theoreticals. We'll just stick with as is, Fed as currently composed. Let's move quickly to the last one, which you already touched on with your defend the take. Earnings season is underway. Banks sort of mixed this morning, but nothing disastrous. JP Morgan and Wells Fargo both reported. See, Wells Fargo is the stock is down, but it did beat earnings estimates. JP Morgan is up. See, Wells Fargo down 3.5%. EPS of $1.40 beating estimates by 14.5%, um, but the stock's down 3.5%, which I'm guessing has something to do with guidance. And then JP Morgan, maybe a bit more upbeat tone, They beat by 9%, EPS of $5.07, and stocks up 2.5%. Um, not much to take from one day, but I do think this earnings season will be um, a force for good more than bad, and sort of a welcome distraction, as we've talked about.
The I'm just trying to see what some of the hard data from JP Morgan's earnings announcement was. The first thing that just jumped out at me, they almost doubled their provision for credit losses to 3.3 billion from 1.9. That's never a good look. That may
Hmm.
just be them being overly conservative, um, and trying to price in additional risk, which is a responsible thing to do,
Yep.
certainly. They earned 507 a share, beat the expectations from 463. Like you said, revenue was up 8%, and they're just warning of turbulence. So I don't know if that's less reassuring than I would have liked. If they had said, we don't need to move our loan loss provisions at all, or we're going to modestly increase them, and they'd had the beat, I think that would have been a green light or something of a green light for them. Um, they'll be fine, right? Like JP Morgan was one of the key orchestrators of so many bailouts in the great financial crisis that nothing short of the asteroid that killed the dinosaurs is going to really shut them down. I
Yep.
feel like a company like that is a safe place to be, even if it might not be a great performing place to be.
Yep.
Um, but they have that role and they have that reputation for a reason, and maybe that reason is why they're also upping their loan loss provisions. Um, yeah, I think we just need more data points. I think we
Yeah.
need more because right now we have three financial companies that,
Right.
that are sort of headline worthy that have come out and reported some stuff. Tech will be
Yeah,
one.
that's gonna be a
There's
big
been a
one.
lot of talks. Yeah, all the talk about CapEx increases for the AI trade, all that stuff. Here is we talked about it months ago, I think. Like if they're gonna start pulling back on CapEx spending because they don't think AI is panning out as a big revenue generator, this is
Yep.
the environment to do it. You say, all right, well, we're going to cancel data centers because we're worried about input costs, but partially it's motivated by we're losing money on AI.
Yeah.
So I think we'll glean a lot of information from this earnings season, potentially, as long
And
as we're
just
getting guidance and clarity.
just at a high level, FactSet has pegs earnings growth this quarter or Q1 at 7% in the S&P. Last quarter, it was 11.7%, which was much higher than expectation. I think the expectation was for like 6, 7%, and it came in at 11.7%. If it's 7% or more, I think that'll help move the needle. But again, it may come down more to guidance and language, tone, that kind of. I think a lot of earnings reports the language will be parsed maybe more than other earnings seasons, maybe more than most earnings seasons. But I think 7% growth could be another case of, hard data still holding up kind of a thing.
Yeah, and it's also so like if we're looking at the S&P as just like an asset, right, instead of an index, you price it based on earnings per share of the S&P, and then you price it based on multiples. So the S&P was trading at like 30 times forward earnings. Well, if you're going to bring down the value of the S&P, you either bring down your multiple, so it goes down from 30 times earnings to say 26 times earnings, which is probably about what happened. Or if the earnings numbers come down, then even if you still have a high multiple, that also drags the index lower.
Yeah.
I think what we have seen is people repricing broadly the value of US equities and lowering what they're willing to pay for a year of forward earnings. So, okay, if everything's perfect, price for perfection, yeah, 30 times earnings is reasonable. Now things are not perfect, so maybe 26 times earnings is reasonable. I don't know exactly what those numbers are.
Yeah.
if the earnings in the aggregate for the S&P come down, that would also result in the headline number coming down, the index value coming down, and could then also cause another re-rate where they are now saying, okay, well, no, we're only going to pay 20 times earnings. So I do think looking at like the FactSet estimate and the aggregate earnings per share number for the S&P, which is going to be constantly changing because we're in earnings season. But I think that is something that would probably be useful if you're trying to get a sort of God's eye view of what the environment looks like.
Yeah.
Um,
Yeah.
I don't know.
Yes, we'll see how it goes. I think earnings season being underway is ultimately going to be a good thing. But we'll see how much, you know, people focus on it in the coming weeks and months. Okay, let's get to our guest for today, Bryan Perry, author and founder of The Cash Machine, in just a second. All right, we welcome on Bryan Perry, who is the founder and author of Cash Machine, which is a high yield investment newsletter, also senior editor at Eagle Publishing. Bryan, welcome. Thanks for joining us. It's a busy market to say the least. What have amid all the sort of the tariff volatility the last week plus, but really in the last couple of months, what have you been recommending that your subscribers do? Obviously dividend stocks are a good place to be. Income's a good place to be right now. What have you been recommending?
Generally speaking, that's true, Chris. But you've got bear in mind that we don't know what's going on with this tariff war. It's a highly fluid situation. So most of the assets I have in Cash Machine are American centric. They're U.S. centric assets. They're built on balance sheets that are within the U.S. Some of the international exposure would involve multinational companies and maybe some covered call ETFs, things of that nature. But in general, with I'm in things like convertible debt. I'm in corporate debt. I'm in energy infrastructure, pipelines, things like that. Things that happen here in the U.S. That I think involve, an economy here that's slowing, but not. I don't think we slip into a recession here. I don't think that Trump and company want that on their record that they took and they nosedived the economy for the sake of prideful trade policy, which is this tit for tat is not. It's got a lot of people concerned, but again, it involves around 11% of total GDP. We have a $30 trillion economy here in the U.S., of which about 3.6 trillion of that is tied to import export. So the market's acting as if it's a considerably higher exposure than what it really is. But that doesn't change the fact that the markets are pulling back and we're in bear market, correction territory. So with that in mind, because my portfolio has a blended yield of just a little over 10%, I'm telling people to stay with it and to be mindful of the fact that if the labor market starts to weaken, that would be problematic. But so far, there's no indication of that really rolling over. And inflation numbers of late have been very good. We had great PPI and CPI numbers here this week. Now that's backward-looking data. Forward, people are very concerned about rising inflation, and we'll have to see if that goes. But energy prices are way down, and cost of shelter. The average home now is on the market 54 days in March of 2025 versus 40 days of March of 2024. So shelter index is coming down, and those have been the two major components. Has been energy and shelter, and food is still elevated, but in general. And wage inflation has tamed. Wage inflation was a hot issue, during the last 4 years. So those things have tempered, and so therefore, larger inflation is starting to become under control. Now, whether the tariffs really make that exacerbate all that to some extent in some sectors, yeah. If you're buying a new car or new TVs, sure. But in a lot of other areas of the economy, the service economy, no, I don't think so. And we're a service economy by and large. So I'm telling people to stay with the program, in terms of I think we'll get through this storm and of turbulence, of tariff turbulence. And again, earnings season is going to reveal much of what companies are saying. Is it business as usual? Or are you really going to see a major slowdown in going forward guidance? No one knows. We're kind of driving 55 miles an hour in a thick fog. And so it really just come down to, the transcripts and the CEOs of what? I hear about all this bad news coming because there's a lot of fear mongering on the media because that's why people, it's about advertising. And so therefore, but are we seeing real actual trouble on the ground? And this is all going to start to unfold here in the next 90 days while they're trying to get these deals done with all these 150 countries out there that we're trying to reshape the trading playing field.
So it sounds like what you're talking about really is the sort of soft numbers versus hard numbers that we've been dealing with, where
Yeah.
sentiment expectations are really low. I think we had a sentiment reading this morning that was the lowest on record,
Oh yeah.
but it's not reflected in the hard numbers yet. Is there anywhere in particular that you're looking this upcoming earnings season that's going to give you something to tee off of, like a specific sector, maybe individual companies where your thoughts are, I can sort of pin my expectations going forward to these names, this sector, this industry?
Yeah, I think we're going to see. I want to see how tech spending is. The AI big spend here. If that's going to, I mean, we saw a bit of concern with Microsoft dialing back,
Yeah.
some of their leases on data center. We've all been conscious of that, but I've seen a lot of CEOs come out and give pre-announcements about, we're not going to make our numbers. There's been some views coming out of the travel industry. And again, America seems to be more experiential than more material at any given time in recent history. So we're going to see whether or not there's, material weakness in the travel sector. But I also think that, for those that, there we have some indicators that, that the tech sector is done, companies are going to have to continue to do more with less. Okay, in terms of that's, and after every recession or every major upsetting situation, whether it's a Katrina or a bonding, a vigilante type situation, you find the companies, they actually become more efficient. Okay, after you have time, tough times create more efficiency, more productivity. And so I think that this move into AI is going to, continue to help buffer, much of America's growth at the production level. Now, at the same time, in the sector level, yeah, you have to certainly industrials, materials, all those things that are commodity based. Energy's already, coming way in. So again, but ultimately, those are, that's deflationary, what we're seeing there in a lot of these sectors. And ultimately, does that produce on the other side of this, good material things, because the cost of doing business has been, lowered by quite a bit. I'm hoping that that's some of that language. Brad comes out of some of these earnings transcripts that say, you know what, our cost of doing business, even though we got tariffs coming, but our input costs are coming down nicely. And I think we're going to be able to, have an offset here to where,
Yeah.
the consumer's still going to be okay.
You mentioned that your investments, you have a blended yield a little over 10%. What are some of the types of investments that you typically, you mentioned convertible debt, corporate debt, energy
Mhm.
infrastructure, what you have. What are traditionally some of the types of investments or sectors, I guess, that you look at?
Yeah, yeah. Well, preferred stocks is another one there. In the corporate bond sector, these are non-investment grade bonds for the most part. The low B, single B, double Bs, things in that area there. These are, again, it's like I consider Cash Machine almost like a fund of funds. I've only got like three or four positions in there that are standalone stocks. Okay. And so utilities, we have one in there that uses a little bit of leverage. The Reeves a utility income fund, but it's paying close to 8.5%. And that's one of the best sectors, I think, in this market that you can, have some money buried into. But you can get double the yield by using a closed-end fund that has a little bit of leverage. And so things like that I think, makes sense. I'm coming out today with a recommendation to buy Altria Group. Okay, super defensive. Cash flow monster. The payout ratio of 61% on the dividend and yielding 7.24. But the stock is moving up and to the right. It's one of the best performing looking charts out there. And I just kind of go where money is served best. Okay, and so that's an area there. Mortgage REITs have been hurt pretty good in here, but I think that you've seen the yield curve is steepened big time. So if you're borrowing short and investing long is what the mortgage REITs do, then the spread they're capturing is fat. And so, those yields are up in the 11, 12% range. So, got a couple of those on the books. Looking at covered calls, covered calls on, I got this JP Morgan, JEPI, JEPI, that's on the NASDAQ, or JEPQ, QYLD. So these are, you can buy the indexes, XYLD, you can buy the S&P 500 and the NASDAQ and even the small caps. And then, these closed-end funds, they sell covered calls and ETFs out of the money, just out of the money calls. And those are capturing between 10 and 12% yields as well. So you can still be in the stock market and still be generating a double-digit yield, while at the same time, you're riding this out and then, dollar cost averaging, as the market does give you those opportunities. I mean, bear in mind, for people that missed, the rally from COVID, this is the next biggest pullback we've seen.
Right.
And, and I believe that the Fed is going to probably have to intervene at some point here if the long bond goes above 5, or the 30-year, which is very close to being that now. Then I think you're going to see some intervention here by the central banks, not just and because rates around the world are heading lower. So ultimately, that should drag down our rates too. But we're the reserve currency, we're reserve bonds, and I think that that's going to be where we have a kind of a resolution moment for the market. But coming into a Friday, we've had a lot of bad Fridays in a row, and it's just a matter of sticking with what you believe until the evidence is there to prove otherwise. And that would be weaker labor numbers, draconian numbers coming out of companies that are really lowering guidance. You didn't see that this morning in the banks. So we don't know, but we're not seeing a material slowdown in our business, especially JP, the biggest bank in the world. So I'm looking for, and there will be some companies that just say, we're totally dependent upon tariffs, and we're going to get screwed left and right. Again, staying focused on U.S. businesses that are U.S. centric, where 90% of their income is derived from the U.S. economy, much of that being the service economy. I think we can get through this to where on the other side, people start to see some progress on the budget, the twin deficits, and also that we don't slide into an economy because the labor market's still pretty firm.
Now, you mentioned the dislocation in the bond market and the equity markets. Are you concerned or doing any kind of hedging against a weakening dollar right now?
Yeah, I have a pretty good slug of gold position between 5 and 10%. Okay, and that's involved in the IAU, which is the other large one. The GLD is the most popular institutional, but IAU actually has a lower expense ratio. And then GDX, the gold miners. Okay, so that's a combination. I wish I bought the FXF, which is the Swiss franc ETF. My God, things like it's got straight up. So, and that is one of my bunker types of situations. I didn't think we'd get to this point. I actually thought a lot of where this tariff thing would be resolving itself long before where we're at right now. Because you saw it coming, but everybody dug in, and it's there's a real disdain for Donald Trump by a lot of countries around the world, because he comes at you, carpet bombs, right? And then basically, he tries to work it out. And, he's like the bully on the playground, right? He can pick on one guy and beat him up, but now all the kids have ganged up, right? Now they're going after the bully. That's kind of how I see it. And this is a simple way to put it together. And, he's just, he is what he is, at the same time, I think the policies are generally good, because this $36 trillion elephant in the room has to be resolved. Okay, the interest is already more than the defense budget. Our trade balance was imbalance again, was way up for the first quarter, and we just need to take care of that particular larger thing. And that was the big ball and chain through the last 4 years, was like the budget deficit. Now tariffs have seemed to take precedent over that, but this is all part and parcel to helping resolve that issue. And going at it with a bazooka wasn't popular. I would have preferred to see him phase this in, take the most egregious, offenders, like Vietnam, and then start there and just set an example. So you got a template as, okay, here's what we did with Vietnam. Now we're coming for you too, and work your way down the chain, of the most egregious offenders down to, your least offensive trade partners. But that didn't happen. They came out, with guns blazing, and it just really was disruptive all the way around. And it's unfortunate. But I think that Scott Bessen's doing a decent job, but he's got his hands full. He's
Right.
met with Japan and Vietnam, and now he's got to, he'll be, and the whole team is after this, but it's going to take the bond market here to settle down, before this market's going to turn higher. I think the market can actually put up with some of the trade narrative because there's time now. We got a window
Yeah.
of months, okay? But what they can't put up with is watching yields, take off and losing control of the long end of the curve. The Fed controls the short end of the curve, but they really don't control the long end of the curve unless they go in there and actually start buying.
Right. And you, in addition to high yields, dividends, income, I know that one of your services through the cash machine is a micro cap stock trader.
Yeah.
Obviously, small caps, micro caps have had a rough go to start
Oh
the
yeah.
year and really the
Yeah.
last few years. Are you seeing the same kind of opportunity sort of on the other end of this with micro caps that you're seeing with large caps or high yield stocks?
Yeah, a couple of things. I mean, we've taken a couple trades on there when we get them. I mean, it's like because you do get these pops. Quantum computing seems to be, really where the next, big thing is. And we got one QBTS, which is a D-Wave. That's probably the best in class in that sector. We had IO&Q. We owned that at 7,
Yep.
flipped it at like 15. It went to 50. Now it's pulled back like 21. It may get back in that name. They've got really good deals with the Air Force and, just there's a bunch of smart people running that outfit. So I think that that's where you can hunt for good trades. I've traded in and out of Rocket Mortgage a couple, 3 times.
Yep.
And I still think now they bought Redfin and Mr. Cooper in the last they did 2 deals in the last 2 weeks, right? So that's a really nice looking package coming together, especially if rates do start coming down. Then I think Rocket's around 11 and a half. Full disclosure, I've been buying that for accounts. I think that stock can go way higher in a better interest rate environment. And then, there's special situation stuff. We've,
Mhm.
there's always, I stay pretty much out of the biotech space because that's just, petri dish types, early stage stuff that's really hard to call.
Right.
But, security, we've got one that's going to rival, that's getting into TSA and things like that. Liberty Defense looks good. We're into nuclear, uranium, UEC, so that looks like that's a good 10-year pull for uranium miners, because nuclear is, taken is now interested in the interest level has really risen in that. So that's pretty much the focus. Looking for big themes that have some secular growth to them. But it's very skittish money that's in microcaps. It just it's like watching neon fish bolt from one side of the fish tank to the next, when a headline comes across. And so
Right.
you just got to be quick to the trigger when you do get a trade, because it is called microcap stock trader, not microcap stock investor. So
Right.
I am looking for scalping some of these quick trades when they come up, and because you can get a quick 20, 30, 40% move, and then you have to ask yourself why not in this market.
Yeah.
Take it run. Yeah.
I think that's great advice. You can actually, for our listeners, you can learn more about Cash Machine and an income strategy that you're recommending right now on cabotwealth.com/street. That's going to redirect you to that informational page. But before they do that, is there anything else that you would like to leave our listeners with?
Well, yeah, I think if you get another chance to, for growth, I mean, I've been picking up American Tower down here, AMT. Okay, it's a really good story there, and Berkshire Hathaway when that dropped, around the 480 level there, that was a really good buy. I've been buying some Duke Power, DUK.
Hmm.
I did buy some JP Morgan, and I've been buying BJ's Wholesale Club a little bit below where it trades here. Got around 110, 111. Trades around 118, 117. Just a very, very well-run operation that's kind of like Costco 2.0, And for yield, look at the InfraCap MLP ETF. They do all the conversions of K1s into 1099
Oh,
internally, so you don't get hit with that. Okay, so AMZA is paying 9%, and that pays a monthly dividend. It's pretty nice to be buying energy infrastructure right in here, right now. So I think that makes sense in here.
That's a great recommendation. Not having to manage the K1s.
Yeah,
That's
yeah.
huge. Like
Uh,
if you were
and for
looking at
IRAs too. Yeah,
MLPs,
right. Because you don't run into what is UBTI, income for
thousand,
IRA.
yeah.
Right? Yeah. So this way you can buy it in either retirement accounts and or regular cash accounts. So I would leave that. That's probably the right, and that's trading higher today against a down 300 market. I think that's people are starting to shop for where's the toll takers, in this market. They're U.S. Based, and it's just you got to move fuel at whatever price it is, and gas and liquids and things like that. So I like the big natural gas story going out there. I think it's clean, it's green. We're the Saudi Arabia of natural gas, and we're exporting a ton of it through LNG. So it's a major thing. Yeah.
Well, Bryan, thanks so much for joining us today. Really interesting insights and lots of great recommendations. And again, if you want to hear more from Bryan and learn about his number one income play, go to cabotwealth.com/street. Bryan, really liked having you on. Thanks for joining us.
All right, Chris, Brad, thank you very much for having me. I appreciate it.
All right,
Thank you.
take care.